The second biggest bank failure in US history has just taken place. Silicon Valley Bank, aka SVB, just pulled an SBF and told people, hey, we don't have any of your money for you to withdraw. Okay, thanks, bye. All right, there are some key differences between Sam Bankman-Fried shenanigans and Silicon Valley Bank. They're actually two very different situations. I just found it interesting that these two institutions both have similar initials and they both seem to have lost billions of dollars of other people's money. So the Bankman, of course, he was running a crypto Ponzi scheme that was insolvent from the very beginning. But SVB, along with Silvergate and Signature Bank, they failed due to a bank run, which is where lots of people go to withdraw their money from the bank at once. But the banks don't actually have all of your money inside of a vault. There aren't any banks that keep all of their customers' cash on hand because they all engage in what's called fractional reserve banking, which, as the name suggests, means they only keep a fraction of what's on their books in their reserves, in their vaults, or at a nearby location to be delivered with a Brinks truck. Now, banks have been keeping people's money this way for a long time, and as long as everyone doesn't all try to take their money out at once, the fractional reserve banking system actually works really well. Well, at least for the banks, because let's say you deposit $100,000 into SVB, they could then lend that out, or they could invest it themselves and make maybe a 10% return on that before you ask to withdraw your $100,000. And then the bank, they can just pocket that 10K that they made. You got your 100K back, they made 10K off of your money, basically for free, and everything's great. And hey, sometimes the bank will even give you a fraction of that 10K, a fraction of those profits that they made to their customers to encourage people to put even more money into the bank. Now, in SVB's case, they were mostly investing this money into long-term treasury bonds. Now, these used to be very popular with people a long time ago. Maybe you've heard your parents or great-grandparents talk about them, but these days, people are usually going to invest in just about anything but bonds, because bonds tend to give you some of the smallest and slowest returns compared to, well, just about anything else. But the great thing about bonds, even though they give you small returns, they give you some of the best guarantees for actually getting a return, assuming your government doesn't just totally collapse. Because at the end of the day, what a government bond is a guarantee from the government, a promise from the government that they're going to pay back the value of that bond one day, plus some periodic interest. Now, while bonds are very boring for normal people, they're great for normie banks. It's usually a good thing if your bank is investing in bonds because, like I said, it's a very solid, secure investment. It does mean that the money isn't liquid, though, so everyone can't go and pull it out all at once. But as long as the government doesn't collapse, then the money's going to be safe. But Silicon Valley Bank, it wasn't a normal bank that normal people who don't normally take out huge sums of money out of the bank account all at once use. It was a big tech bank that companies like Roku, Roblox, and Etsy were using. They were depositing millions, or in some cases with some companies, billions of dollars into these accounts. And if you've been paying attention to the news about layoffs in big tech, then you know that the entire sector, the entire technology sector, has been in a financial crisis for some time now. You've got companies like Facebook, Microsoft, Amazon, and Google who have been having these waves of layoffs, making these headlines where they lay off like 10,000 people in a matter of a few days. And Twitter, of course, got gutted when Elon Musk bought it. He laid off like, I think, 2/3 of the company or something like that. So the customers of Silicon Valley Bank, they were almost entirely Silicon Valley venture capitalists, which means that the financial health of Silicon Valley Bank was directly linked to the health of the tech industry itself. Now, at this bank's peak, it held more than $200 billion in assets. But the thing is, they had fewer than 38,000 corporate accounts that $200 billion in assets was spread across. And keep in mind that corporations, corporate accounts, and especially when we're looking at, these are some of their customers, like Circle, they had $3.3 billion in accounts with SVB. Roku had $387 million in accounts with SVB. So when we've got these really big companies that have accounts with a bank, it's not just in one account. They end up splitting it up into dozens of different corporate accounts that have different purposes. Oftentimes it's split into different regions. So you've got to think, Roku's got accounts like Roku 1, Roku 2, probably all the way up to like Roku 37 or something like that. And in some cases, Silicon Valley Bank would also sign these exclusive banking deals with clients, meaning that they could only use that bank for their business. So you've got to imagine, in cases where that's been signed, the business might have hundreds of accounts with SVB because they can't have dozens of accounts with a dozen different banks. Now, the situation that SVB found itself in, where it's managing almost $250 billion in assets between, maybe a few thousand different companies, but they're all concentrated into the same industry, this was actually a really good situation during 2020 and 2021 when big tech was booming. Really, it was the only industry that was booming at the time because everyone was forced to stay home and to work from home, which was a very difficult adjustment for a lot of different companies. But of course, companies like Facebook, Google, any other big tech industry, they already had the majority of their employees working remotely. And since people had to stay home for entertainment, in some places they weren't even allowed to just go outside, people would be on their phones and on their computers, most likely consuming content from a Google, Facebook, Amazon, or Netflix property, further compounding the money that these companies were making. So yeah, COVID really was the best thing to ever happen for big tech's profits. Makes you wonder when they're going to end up pulling something like that again. But the problem with SVB is when this was happening, they weren't diversifying where they were investing the money that people were depositing with them. They put it all into these long-term investments like bonds, where what they were getting was very rapid short-term gains. So like I said, they had the money, it was just tied up in bonds, which means once the vault was empty at SVB, once all the cash was out of the vault, they had to start selling those bonds prematurely to give that cash to customers. Now, normally when you do this, you end up losing a little bit of money because you have to pay a commission for the transaction when you sell bonds prematurely. But also, if interest rates have gone up, like they have recently, quite a bit, then you have to sell the bonds at a discount, which means now you're paying these fees to lose money on the sale of that bond. And since it's a bank, they're ultimately paying fees to lose money on the transaction, and then they have to still give you all of your money back. And you can see that when you do that 38,000 times over to liquidate all of those different accounts, you can clearly understand why the bank failed. Now, President Biden came on TV yesterday saying that everything was going to be all right, guys. Everyone's deposits are going to be there for when you need them. He basically had to do this to give normal people some assurance over their money, to keep people from all over the country going to their banks and withdrawing all their money and basically throwing us into another Great Depression. So this is just kind of a quick, brief of what he said is going to happen. So the FDIC took over the assets of Signature Bank and Silicon Valley Bank. He also said that no losses would be bared by the taxpayers, and that the money would come, the money to, bail out, in quotes, these banks would come from the fees that banks pay into the deposit insurance fund, and that the bank management is going to be fired if the bank ends up getting completely taken over by the FDIC, and the investors in the bank are not going to get their money back. because that's how capitalism works. So that's a first, investors aren't getting bailed out, executives aren't getting bailed out, just the depositors, and they aren't getting bailed out with taxpayer money. So sounds all good, right? There's just one little loophole though. The executives of SVB, they already cashed out before the bank failed. They saw that the cliff was coming and they decided, let's make several $1 million before everything collapses. Why not? So I think those people, they really do need to be held accountable because they're the real criminals in all this. They saw that this collapse was going to happen. They probably saw that what SVB was doing, getting these short-term gains and then trying to put them into long-term investments was not ultimately good. But they're like, we could just cash out before things are going to crash because we're going to know before the public does. So yeah, I do think that there needs to be something done about that. But hopefully the collapse of SVB and Signature Bank doesn't mark the beginning of another global economic collapse.